Hi there, welcome to the Open here on BNN Bloomberg. Happy Friday. Last time I get to say that on air. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canada's February retail sales rose less than expected. Statistics Canada says overall retail sales increased 0.7%, and that was below forecasts of a 0.9% gain. Motor vehicles and parts were the top performers. The data suggests that consumers are still spending, but cautiously, as higher prices continue to weigh on demand. Wow, look at that. Shares in Intel soaring in the pre-market after the chip company beat revenue estimates in its latest quarter. It also came in ahead of expectations with its sales guidance for the second quarter. CEO says the strong performance is being driven by rising demand for its core processors, adding that CPUs are asserting themselves as a key foundation of the AI era. And the federal government has approved a major natural gas expansion project in BC. Ottawa says the $4 billion Sunrise expansion will add capacity to Enbridge's West Coast pipeline system, helping to meet growing energy demand in the province. The government says construction begins this summer and that the project will support LNG exports. U.S. futures set for a mildly positive open this morning amid that seemingly endless confusion and uncertainty over when the conflict in the Persian Gulf will resolve. And let's have a look at the TSX. Of course, our market has been supported this week by higher oil prices. Let's have a look at oil, speaking of which. And oil now down today, but only losing about 12 cents. And let's have a look at gold. Gold down as well. It has been drifting lower over the past few sessions. Let's have a look at the Canadian dollar. Our currency up, holding above 73 cents US. And finally, Bitcoin. And Bitcoin has been mounting something of a recovery from the lows of earlier this winter. As I just mentioned, Intel shares sharply higher today. The company reported higher sales and raised its forecast, saying there's a resurgence in demand for its central processing unit computers, and that is boosting NASDAQ 100 futures. We're joined by Elliot Johnson, Chief Investment Officer at Evolve ETFs. Quite the move. Thanks for joining us. Quite the move in Intel this morning.
Yeah, thanks for having me here. When you look at Intel's chart, and you have to zoom out a lot if you want to see where Intel is compared to its previous all-time high, which was in September of 2000.
Wow.
It shows, but when you look at that chart and you see the performance over the past year, it's most of that gain and that recovery has happened in the past 12 months, which really tells you a lot about where the AI trade is and how it's broadening out to the entire chip sector. And I think their earnings yesterday show that this is not just the promise of something to come. This is actually being delivered because the earnings beat was unbelievable.
All the buzz has been about the graphic processing units that were the origin of the devices NVIDIA now sells. But Intel's saying, hey, these central processing units are a big part of the story.
Yeah, for sure. The AI trade initially was kind of confined to NVIDIA, right? It was a GPU story.
Right.
And I think in recent months, people have started to realize, actually, there's a lot of other elements to it. RAM prices, for example, are at skyrocketing prices because the amount of RAM required for these data centers has gone up. But then you also always need the CPU. And with data center construction continuing to grow so rapidly, you need the processors that are made by Intel. And I think, this is the knock-on effect of some of the stories you see about fundraising from folks like OpenAI. When you hear about the billions of dollars they're raising, they're spending some of that money on chips from Intel, on chips from NVIDIA, on RAM, and on data center construction.
There's a headline here. U.S. President Donald Trump's bet on Intel just made the U.S. government nearly $30 billion US on its investment.
Yeah, he's not a bad portfolio manager.
Yeah, oh, God, don't tell him that. We'll never hear the last of it. Yeah, well, that's interesting, isn't it? Intel has outpaced NVIDIA over the past year.
Well, NVIDIA, I think, got to the point where everybody who wanted it owned it. And I think it kind of tells you the story that, sometimes you can be right if you pick one stock, but overall, you want some diversification among a theme, right? So I think big tech overall is the basket to own. And rather than just trying to pick one or two winners, you may get it right, but do you get it right at the right time? How much forward demand has been priced into the stock today and things like that? This is one of the reasons why diversification can help.
One of the classic ways to play tech has been to buy QQQ, the NASDAQ 100 futures, but you are picking up a bunch of non-tech stocks. So you guys have just launched QQQT. What is that?
Yeah, so there are only 45 tech names in the NASDAQ 100. And so what we did with QQQT is we partnered with the NASDAQ. We actually met with them and said, can you make us an index that is only the tech names? Because people buy the Qs thinking they're getting tech, but you also get other companies in there like Lululemon or Walmart. And that doesn't really align with what people think they're buying it for. And I think the reason why investors need that additional tech allocation is because in most portfolios, you have a typical balanced broad market indices, things like the S&P 500. But you can see just from looking around and seeing the news that there are times when you need a sector increased allocation to a particular sector. So by having just the tech names, you're diversified, you're not picking a single stock, but you're still in the biggest tech index in terms of the exposure.
So can you explain this then to me? Its official name is the Defiance NASDAQ 100? No, I'm getting confused.
No, sorry. That's the same ticker in the U.S.
Oh, I'm sorry.
Yes.
Okay.
So that's okay. But it's the Evolve NASDAQ Technology Index.
So this one is just in Canada?
It's just in Canada.
Oh, okay.
That's right. Yeah.
Is it a straightforward ETF? Does it provide an income wrap or anything like that? Covered calls? Or?
So we have a version of it with covered calls.
Okay.
Ticker is QQQY.
Okay.
So you can take your pick if you want to have some additional income using our active management on our options program. There's a flavor for that as well.
Oh, okay. And when did you launch this one, the straightforward one with the T?
It's been a couple of years actually, and it's grown super well. And I think that especially in recent times, especially in the if you look over the past couple of years, it's been a very good choice for investors to get access to tech. It's been performing because of tech leadership in the broad market indices. It's had very, very good performance over the past few years, and people are really noticing that.
So you launched it, I believe, July of 2023, was it?
That sounds about right.
Okay, yeah. And anyway, over that time period, it has certainly, it's gone up from less than $24. It's now north of $43, according to my screen.
Yeah, that sounds right.
What are your other thoughts on debt in AI? Oracle is the poster child there, but there are worries about the amount of borrowing they've taken on.
So the thing about debt within a company really has to do with servicing capability. And I think one of the concerns that people had, if you go back about 6 months, was, is there a revenue story to support the spending? And I think what we've seen in the past few months with the massive expansion in revenue at Anthropic is that the answer is yes, and the spending is going to come from the enterprise. So we're not really concerned about how the capital is formed, whether it's equity or debt, by the companies that are raising money to expand their AI footprint, so long as they have great products to bring to the market. So I think this is the way to think about AI spend and to think about these companies. They're obviously kind of the 6 big AI companies if you think about the apps you might have on your phone. The story's gone from a smart chatbot you carry with you into something that now can be a coworker with you at the office, right? Doing tasks alongside you.
Yeah.
That really drives more spend. That spend can support servicing more debt. And, interest rates are still, from an historical perspective, pretty low. So it's pretty advantageous for companies to go and get debt at these prices in the market.
I'm just wondering, is that AI companion going to start prodding you though in the afternoon? You've been looking at Instagram too long. Maybe get back on task.
Well, we could all use a break from our phones, I think. But I'm not sure AI is going to be the thing that gets us there. I think everyone needs to go outside and look at the sunshine once in a while.
Thanks very much indeed. Elliot Johnson, Chief Investment Officer at Evolve ETFs. Coming up, we're going to hear from the CEO of Raymond James. We're going to hear how recruiting and a major investment in AI are helping to fuel growth. Raymond James posted strong growth in its latest quarter, with new assets jumping $23 billion US. Advisor recruiting helped lift wealth management revenue, but of course, you got to pay those people. A higher compensation weighed on margins. We got perspective from the Raymond James CEO in a Bloomberg interview.
We had a record recruiting year last year. We recruited $401 million of production with advisors from their prior firms. This year, we're starting off the first half of our fiscal year with a stronger start than we had last year. We had 7% annualized net new asset number for the first half of the fiscal year, which is amongst the highest in the industry. And that's because two things. One, we retain our existing advisors. The retention of our existing advisors, despite the highly competitive environment, remains very high. And also, we're a destination of choice for advisors from other firms, experienced advisors who are looking for both culture and capabilities to best serve their clients.
And I wonder, a little bit about the impact of AI, and this is something we've discussed before, but you think about the muscle memory that's being developed. A lot of people just go to some of these LLMs, ask them questions, and there's rumblings that a lot of people are doing that for financial and wealth management advice at this point. So, how do you turn that sort of existential threat and harness AI to turn it into a tailwind for Raymond James?
No, you're absolutely right. Technology has changed our business over the last 2 decades with the internet and with online trading, and with AI, we think it'll continue to change the business. But the one thing that you see, we had 3 client events in the last quarter across the country. The one thing you see with those advisors and clients at these events is that these relationships are deeply personal. It's not an advisor-client relationship. It's not about a transaction. It's not just about a portfolio return. In a lot of cases, these are very good friends that and they understand their financial priorities. One of the things I said on the earnings call last night was, it helps me sleep better knowing that my financial advisor, if God forbid something were to happen to me, could take care of my wife and my family and understands what our financial objectives are, has a deep relationship with my wife, knows my kid's situation. That's not something I'm going to trust to a bot or an AI agent, no matter how good the algorithm is. So what we're focused on is using AI to enable the advisor to develop even more deeply personal relationships with their clients through technology.
I understand that, certainly for existing clients. But how do you future-proof this for a generation that may not be old enough to be your client now, but a generation that is sort of growing up in this environment where they are used to just talking to a computer or their phone or whatever the hardware will be? Are those folks also going to sort of end up in the human wealth channel, or are they going to end up talking to bots? Yeah.
We have a lot of conviction that they will eventually seek out human financial advisors. We saw a little bit of this with robo-advisory right before COVID. A lot of younger folks using robo-advisors. COVID hit, incredible amount of stress and complexity, and it wasn't sufficient for them to just get an email from a robo-advisor saying, we'll call you back in 48 hours, we're kind of jammed up right now. And we actually, as a financial advisory industry, during COVID, saw record net new assets from existing advisors bringing on new clients because they said the direct channel in this period of stress isn't sufficient for me. So what we're doing is focusing on technologies, products, and AI to help advisors provide more holistic advice, because that's what clients are going to expect from their advisors, more holistic advice, but also more tailored advice for their financial needs.
I am curious that, particularly in the moment, what type of advice clients are asking of the advisors. Is it more complex now, given the geopolitical uncertainty and also just the big structural changes going on in our society, from AI to industrial revolution, all these other things that are just changing the complexion of maybe what the economy is and what should you be investing in?
Yeah, the most important piece of advice that financial advisors have provided to their clients over the last 5 to 7 years is don't overreact to headlines, don't overreact to social media posts, because the one thing that clients have learned, over the last 5 to 7 years is when you do that, you're going to overreact and miss the opportunity. And so what advisors do is help their clients in those periods of emotion, high stress, say, actually, they rebalance their portfolios and buy into dips. So we saw that with Liberation Day concerns last year, where the stock market kind of crashed in a week. And what we saw was high levels of rebalancing, so advisors were helping their clients buy into the dip versus to sell in the dip. And that's the most important piece of advice, is just come up with a 10-year financial plan, 15-year financial plan, and stay aligned with it, and don't let headlines and emotion derail you from that financial plan.
It's like the casino, though. They want you to keep your money just riding on the table, because, of course, they get their cut regularly. Anyway, I'm old and cynical. That was the CEO of Raymond James talking to our Bloomberg partners. Okay, tough talk over trade ramping up on both sides of the border. We're going to hear from Jean Charest, one of the newest members of the Canada-US Advisory Council. The Prime Minister has outlined some of the issues on the table for the review of the CUSMA trade agreement. Tough talk ramping up on both sides. We got more from Jean Charest, member of the Canada-US Advisory Council.
We have to, call things as they are. And the American side just isn't very shy about expressing their positions. I think it's done in a tone that's reasonable. And what the Prime Minister is saying is pretty straightforward. The American side saying give, and pointing out that that's fine. We're ready to negotiate, but what about the tariffs you have that are damaging to our economy, to workers in Canada, and unjustifiable? And by the way, Mirella, that hurt the American economy. I mean, this isn't a trivial issue. On aluminum, on steel, softwood lumber, cars, name it, they're hurting their own economy. So let's get serious, sit down, and have a good conversation about the future of CUSMA and move ahead.
Alcohol, of course, one of the irritants, because some of the provinces have pulled American bottles off the shelves. Jameson Greer says he's considering launching enforcement action to deal with that, the U.S. trade rep there. Has that been raised officially, do you know, and what could that look like?
As far as I know, it's the first time it's ever been mentioned as enforcement. I'm not sure what it means. It points to one of the particular features of CUSMA. It has been negotiated, Mirella, by the federal government, who are legally bounded by it, but not the provincial governments. In our federal system of government, the provinces are not bound by a trade agreement in the areas of their jurisdiction if they haven't signed on to it, which is not the case in CETA with Europe. In the case of Europe, the provinces have signed on, and so they are accountable and legally bound by the agreement. So I'm not sure what he means by enforcement. It's the provinces who decide what products are on the shelves. And as the Prime Minister's pointed out on all these issues, we can all make some progress fairly rapidly if there's a willingness on both sides to do so, and there is on the Canadian side.
Dairy, of course, has always been a problem, dairy restrictions in the country for imports. The U.S. wants some of these irritants to be dealt with, basically pulled back ahead of even sitting down for a review. Do you think Canada would make concessions just to get to that spot at the table?
We're not in a position to make concessions. We played in this movie before. We have responded to Americans under the Digital Act. We withdrew our own counter tariffs when they were out there. And by the way, the counter tariffs, to be very clear, Mirella, and we were very much aware of that, were even harmful to our own economy. And so, initially we thought this is something that would be helpful. We came to the conclusion that no, and we withdrew them. And by the way, the same is true for the Americans imposing tariffs on themselves on steel and aluminum. So the question really here is, at one point, we need to sit down and have a good conversation. We know, Mirella, that the American business community is in total support of maintaining CUSMA. Our supply chains are very, very much linked. And that's a characteristic of our trade relationship with the United States. So we want to have a broad conversation, a good one that's about mutual interest as opposed to one side asking the other side to give all the time without doing anything. And this is, I guess it's the Trump method. But frankly, at this point, we know what it's about, and we are bound to and determined to defend Canada's core interests.
Let me get your take on the Conservative leader's suggestion that perhaps Canada use something like critical minerals as leverage. As an example, are we in a position to do something like that? Would we consider something like that?
Well, let me first note that I think it's encouraging that the leader of the opposition, Pierre Poilievre, has been supportive of Canada in these negotiations. Yes, well, critical minerals is a big part of the deal. When the American administration says we don't need anything you have, we do know that the American side needs energy from Canada. That's one part of it. They produce 13.6 million barrels a day. They consume 20. We supply them 4 to 6 million barrels a day. Critical minerals, another very good example. And then this is something that is extremely important in the short term because of the hold that China has on the market. Canada has them all, whether it's rare earths, lithium, nickel, titanium, name it. I mean, we are the country that holds a lot of these minerals. Our view is let's work together to develop these minerals and supply American and Canadian companies that need them very badly.
You were on the other advisory council ahead of being chosen to stay on the council, which has been sort of reinvented here. Because of that position, I'm wondering if you have a different idea of why the U.S. treats Mexico very different from the way it deals with Canada. They've made progress. They've been much more open to having the conversations. Yeah. We've heard that time and time again. Why do you think that is?
Mariella, this is very straightforward. The agenda with Mexico and the United States is very different from the agenda between the United States and Canada. Think cartels, drugs, border, immigration, the presence of Chinese companies in Mexico. Very different set of circumstances. The Mexican side and Canadian side are in very close contact. We led a very successful delegation there. They are going to be coming here to Canada. We talk to each other. And at the end of the day, Marella, we may very well end up with a tripartite agreement, but also other bolt-ons on both sides, on Mexico and Canada. We're not offended by that. We don't think it's a bad idea as long as it works in the interest of Canada. So Mexico's a different story. And we're both going to defend our core interests and work together on things where we agree.
Opening bells coming up next. Opening bells on the last trading session of the week at the NASDAQ. X-Energy is doing the honors at the NYSE. It's contango, silver and gold. And at the TSX, it's members of SVX opening the market. It is time for the first 15. And let's check in on the big North American benchmarks as we get going on this Friday morning. You can see stocks pointing upwards in early trading. They were under pressure yesterday amid pessimism that the Iranians are actually moving towards a peace deal with the U.S. Apparently, Iran's chief diplomat is going to visit Pakistan, but U.S. President Donald Trump, he's not backing down on his blockade. But Pakistan has been the main mediator between Tehran and Washington. It's not clear whether this official from Iran is going to meet U.S. officials. Apparently in Islamabad, the Pakistani capital, residents are ticked off about roads shut and blockades everywhere because of security that's been imposed because of the talks that have been taking place there. Let's check out a couple of stocks of interest. As we mentioned on the news headlines, the federal government has approved Enbridge's massive expansion of a West Coast natural gas pipeline system. And the Prime Minister, of course, has made it a priority for this country to expand trade corridors, Dow Jones notes, and approve resource projects. So it looks like it's part of that general drive. And let's have a look at Lululemon because they announced a new CEO who takes over later this year. She comes from Nike, but Heidi O'Neill, but kind of tough Bloomberg reporting that she is associated with former Nike CEO John Donahoe, who is seen as having been a failure or certainly having missed opportunities during his leadership of Nike. He had a big push to sell more of the company's products through its own stores, and that ended up alienating some key retail partners. So maybe that's why we got a fairly negative reaction to news of Heidi O'Neill taking over. As Bloomberg puts it, she has ties to one of Nike's biggest missteps. Up next, let's go there now. We've got Jeff Morgan. Oh, we don't have Jeff Morgan. Maybe let's have another. Do we have time to look at the U.S.? Let's have a quick look at the U.S. market here, just to see how the S&P 500 is opening. And you can see, I don't think it's at a new record high. It does seem, of course, that the Americans will have to do something to ease off on this energy crisis. Apparently, according to the Dallas Fed, we heard about this yesterday, U.S. oil executives are not happy about the uncertainty in the crude market. You'd think they'd be delighted with prices going up. But they are complaining anyway when they talk to the Dallas Fed in anonymized comments that this policy uncertainty is making their jobs harder. And the U.S. stocks right now, the S&P 500 slightly down from Wednesday's record close. We'll be right back. Let's check out some U.S. stocks of interest. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Jeff, update us on Intel. They finally got above their dot-com peak.
They did, yes. Shareholders there are partying like it's 1999. Yeah, as you said, Intel has now risen above the level that it had at the turn of the century, turn of the millennium. The results this morning and the forecast were blockbusters. So this is the top performing stock in the S&P 500 by a country mile. This stock was up 28% in the pre-market session. So definitely worth watching over the course of the trading day. If these gains hold, Intel looks like it's poised to gain about $94 billion in market capitalization just today. A 27% gain now. So pretty remarkable. What is remarkable here is the forecast. The company was very upbeat, very optimistic. And for the quarter that's going to end in June, the company expects to have revenues of between $13.8 and $14.8 billion. That is well ahead of Wall Street estimates of about $13 billion for the period, by quite a fair margin there. So analysts very, very excited about what they're seeing here. The stock got two price target bumps, one from JP Morgan, the other by Truist Securities, and one upgrade from Evercore ISI this morning, upgraded to outperform. So yeah, quite a happy morning for Intel shareholders who, as I said, are now seeing the stock above the level it was at in the dot-com peak.
SLB, aka Schlumberger, under pressure this morning?
Under pressure, yeah. We're going from the top of the S&P 500 to the bottom. This is one of the worst performers in the S&P 500 so far. And so what happened? This is an oil field services company that theoretically would be gaining on higher oil prices. But the disruptions in the Middle East with the Iran war have caused some disruptions with its business in Qatar, in Saudi Arabia, in the UAE, and in Iraq. And so those four countries kind of weighing on results. Everywhere else, the company expects to see year-over-year increases in activity, but these four countries and operations there are weighing. So the stock is down, worth watching over the course of the trading day. Oil prices are up today, and the company does expect to see more activity elsewhere, but this is a big hit for the company in this quarter.
Thanks a million, Jeff. Jeff Morgan of Bloomberg.
Thank you.
Right, so there is hope among some investors that these talks between the US and Iran, when and if they resume, will push towards an end to the Persian Gulf conflict. Markets up a little bit today. We're joined by Fiona Wilson, Senior Portfolio Manager at Guardian Capital. Thanks for joining us.
Thanks for having me here today, Andy.
We talk about rah-rah AI a lot and massive spending plans, but you're here to remind us that dividend growth is a crucial driver of returns for investors.
Yes, exactly. We look at dividend growth as a total return approach. I'm a portfolio manager on the global dividend portfolio, and we don't go for yield for yield. We're not looking for the highest yielding company because they often are a lot lower quality. So we believe to look at dividend growth and going forward 1 year is kind of the where you want to be because it needs to have earnings growth behind it to back that up.
It's interesting. I'm just wondering, there are tools available for investors, but it can be laborious to filter out which companies have been good dividend growers.
Well, you can always look at history, but history doesn't always look at the future, and that's what's happening now in the market. So we've actually been using artificial intelligence to forecast dividend growth since 2018. So we're kind of on the forefront of AI with investing. I mean, now everyone's talking about using AI for investing, but we have a team of engineers, and we've got our own proprietary tools. So we forecast dividend growth going forward 1 year, and dividend cuts, and earnings growth and earnings cuts. So if you look at COVID, over 300 companies cut their dividends globally during COVID, and we navigated, because of the AI, we navigated and we moved out of any positions that later cut their dividends. So it really increases your accuracy as a dividend manager, because the last thing you want is a company that's cutting its dividends.
Your first thought, you have some ideas for us. Amphenol, APH in New York, and they are a supplier of electrical equipment?
Yep, they do electrical fiber optics. So it's interesting. So it's part of the supply chain of the AI piece. They have really strong dividend growth. They've increased their dividends in the past year, about 30%. Again, not a high yielder because we're focusing on the dividend growth and the earnings growth aspect. So data centers are one of their main customers, but they also in the aerospace and defense. So it diversifies their earnings. So they're not just focused on just the AI piece of the data centers. So they're actually a really strong company, and we like them. And they're in the information technology sector.
Parker Hannifin, a long-standing U.S. industrial company, they're big in the motion and control market, for example.
Yes, exactly. So the industrial space is really kind of taking on another look when we're seeing U.S. onshoring. During COVID, again, supply chain issues, a lot of talk of onshoring because of supply chain disruptions. But now what you're seeing with the new politics in the U.S., everything is onshoring. So this is a great company to look at that. They deal with all the, as you mentioned before, valves, all the smaller pieces, but they also actually incorporate AI. So for some of their pieces, they have AI for their hydraulics, and they'll be looking at the machines and testing it, sending the information back to their machine learning language algorithms, and it's basically going to be able to catch when something is going to fall apart sooner, when it's going to disrupt supply chains. They raised their dividends as of yesterday 11%. So again, they've been increasing their dividends consistently for over 70 years. So again, taking away from just focusing on a high yield, but more companies that have strong earnings growth coupled with strong dividend growth.
I'm not sure if we showed Parker Hannifin there, but that's interesting. Did you say they've been increasing the dividend for 70 years?
Yeah, so they're a long dividend, but again, not a high yield. Still, well, they're about 0.82% yield as of yesterday in their price.
That's interesting. I wonder, I guess retail investors, they could try using AI to screen for dividend growers. I mean, you have to be careful, something available to the public. It can hallucinate. Yeah,
for sure.
Yeah, but it can give you some starting points.
Yeah. I don't know any tools that are available to the public because we use a random forest algorithm that we have built that has just 2,000 iterations per stock per day. We take the average of the iterations because we find that's very accurate. So, there must be some tools out there. Again, I'm not sure what the accuracy would be.
I don't know if AI for investing, it might tell you, put all your money in scented candles.
Yes, exactly. And then the next day it might change its mind.
Yeah. Broadcom, we don't think of this as a dividend stock, a chip maker, but that's one of the draws, the dividend policy.
Yep. So again, the information technology is not a high-yielding sector, but because it's got really strong earnings growth and dividend growth, that's one sector we've focused on quite a bit. Broadcom, if you look back at Broadcom in, say, 2022, it actually was a higher-yielding information technology stock. It was yielding close to 3%. Now it's yielding just under 1% because the stock has gone up so much. But what we like about it, too, is it's diversified because it has a software piece, too, to it. So it takes away some of the volatility of just having a pure play semiconductor stock. It grows its dividend on average about 15% a year, and it's top of line for profit. It's one of our strong holdings in the dividend in the technology area.
We're tight for time, but Alphabet also an attractive dividend policy, you reckon?
Yep. So Alphabet started paying dividends in 2024. We've seen some of this happen in the tech sector, which is interesting, actually, because Alphabet isn't in the tech sector. It's in the communication sector. But if you look at Alphabet, there's a lot more to it than the Google search. They're getting a lot of their revenue from the cloud piece. So it's 30% dividend increase in the last year. And again, not a high yield, but they've got the visible cash flow. So a total return approach to investing. And that's what they're doing. And they're opening their market up to a lot of investors who were looking for dividends, and now they can buy a stock like Google that does pay dividends.
Fiona, thanks very much indeed.
Thanks very much for having me, Andy.
Fiona Wilson, Senior Portfolio Manager at Guardian Capital. Yesterday on Market Call, we were joined by Gordon Reid, President and CEO, Goodread Investment Council. His focus, U.S. stocks, and his top picks were GATX, G-A-T-X Corporation, GM, and McKesson, the giant drug distributor. Today, it's Greg Newman, Senior Wealth Advisor and Portfolio Manager at Newman Group, Scotia McLeod. The focus, North American equities. Just ahead, Canada's new ambassador to the U.S. Says Ottawa is ready to begin the CUSMA review as wrangling continues on steel, aluminum, and timber tariffs. Canada's new ambassador to the U.S. says this country is ready, willing, and able to start the review of the CUSMA trade deal with partners in Mexico and the U.S. He spoke to parliamentarians. Let's get more from CTV's Jeremy Sharon. Jeremy, thanks very much indeed for joining us. Tell us, what was the gist of the envoy's remarks, please?
Yeah, good morning, Andy. Look, we heard from Mark Wiseman for the first time yesterday, who provided some level of insight into conversations he's had so far and what talks could look like moving ahead before that July 1st deadline for the review of CUSMA. Of course, the ambassador will play a key role in negotiations and is already, on the ground doing so. He's been meeting with, U.S. lawmakers, said more than a dozen U.S. lawmakers he's met with already, and spoke yesterday saying that, he would not provide too much insight as to what Canada's strategy will be specifically going into negotiations, but that Canada is ready to enter formal talks at any point. That being said, the U.S. side, U.S. officials have also said they're ready to enter into formal talks, but those talks have not started yet. We know that conversations are happening, informal talks are happening, but the formal process has not started yet between Canada and the U.S., and the reason being for that is unclear at this point. The ambassador wouldn't answer directly when asked that, and again, shied away from direct details, but did say that Canada is ready to go. Here's more from Ambassador Mark Wiseman yesterday.
I'm not going to discuss the details of the Government of Canada's detailed strategy as it relates to the CUSMA review or the 232 issues here, but I will say that Canada is ready to go in our discussions. We are prepared. We have done our homework, and we are ready to proceed with each of Mexico and the United States forthwith.
Now, you heard the ambassador there talk about 232 issues. He's referencing, of course, the tariffs that still exist under Section 232 on steel and aluminum, on the auto sector, on softwood lumber, some of the most punishing tariffs in place right now in terms of our economy. And we've heard reaction from premiers as well. Premier David Eby yesterday reacting to comments made by Secretary of Commerce Howard Lutnick, who said it was outrageous that Canadians were keeping U.S. booze off the shelves. And well, he said it was outrageous that those tariffs were in place on softwood lumber. And so Premier Eby, like many other premiers, has been clear they won't be putting booze back on the shelves until there is movement on the tariffs that are punishing some of these sectors.
We just got numbers on Canadian spending, retail sales. It showed some strength in the first quarter. But of course, this comes against the backdrop of U.S. tariffs and weakness in investing because businesses are so uncertain.
Yeah, exactly. And we saw another jump, an increase of 0.7% in terms of retail sales, driven mostly by car sales and automotive parts sales. That's the second month we've seen that sector drive an increase for a second month in retail sales. A positive, factor, as you've touched on. But to your point, we're still looking at impacts of these tariffs, reluctance when it comes to investing. The economy is certainly far from out the door here as we talk about further volatility as a result of the unknown when it comes to what the outcome will be of these CUSMA renegotiations. And important, before we go, to just note one more thing. When we talk about this July 1st deadline, it's important to remember we're talking about a deadline for a decision to be made. So by that point, parties involved, being Canada, the U.S., and Mexico, need to determine whether or not they're going to keep the deal that is already in place as is and move on, or renegotiate a new one, which is the likely outcome and what most believe will happen. They just have to make a decision by July 1st. What is likely to happen is that what will follow will be a very lengthy and fully encompassing process to renegotiate a new deal, while in the meantime this deal will remain in place.
Jeremy, thank you very much. Jeremy Sharon, our colleague at CTV News. Up next, how do you find stocks that stand up in good and bad times? John Ehrlichman will have more after the break. When a stock is struggling, investors wonder, will it make a comeback? So what makes an investment built to last? Let's get more from BNN Bloomberg contributor John Ehrlichman. John, tell us what you've been finding out about built-to-last stocks.
Andy, I loved this assignment because it's so easy to talk about a great business model when a stock keeps going up. When the stocks go down and we ask all the guests, what's your conviction of sticking with this name?
Yeah.
You learn a lot. And I talked to Thomas Martin of Globalt Investments, who embraces the reality that sometimes some of his stocks are going to be down. His goal is to outperform the S&P by holding a basket of some stronger potential performers, which means some might be going up, some might go down. And he's basically got sort of a two-track approach. One is traditional metrics like earnings per share. We know that if a company repeatedly beats expectations on profit, typically that helps the stock grow. So you kind of want to lean into those kind of companies. But of course, how do you know if that's going to happen? So there are some less tangible things like, does the company have a good leadership team? Is there a culture of innovation, which I think is very underrated? It's obviously hard to quantify. And also, do they have a product or a service that stands out or is unique? I guess that might be moat-like, but those are the things he's looking for to build a built-to-last portfolio.
Give us a couple of examples of companies that fit the bill here.
Yeah, so we actually have a full list of 12 stocks from him. It's on the website, but also like within that group, here are three examples. Robinhood. So Robinhood has become this popular U.S. trading platform for younger investors. During the crypto boom, they got a lot of activity, then a big pullback, but he thinks they're still innovating and are going to be a place where the next generation wants to be. Spotify, another example. Some people were worried, is AI music going to disrupt the music industry, which has in a lot of ways become Spotify? He says no. I mean, they're already at close to 300 million paid subscribers. And Visa would be a third one. A company that's had these amazing profit margins, concerns. There's been concerns about new payment options like stable coins disrupting Visa, MasterCard. He says maybe, but they still have these great relationships. They're going to figure it out, and it's been a great business. I'm going to stick with it.
Yeah, it's interesting with Spotify. Maybe we could put up a 5-year chart. It's off its highs, but it's hundreds of millions of users, as you say.
And again, going back to, is that the kind of company that is going to continue to surprise to the upside? It's easier to do when the companies are younger. As they get older, obviously more mature, that's not necessarily the easiest thing, but he's betting that they will.
I do have a bunch of CDs. I'm trying to declutter my house.
Artwork on the wall, maybe, would be good.
I mean, I do love the physical CD. But I wonder, just to free up space, should I just go Spotify?
I think you're in good shape, and you could join like a CD, an ultimate CD. You know, you're an athletic guy. Get out there, find new use cases for.
I've heard, I did hear anecdotally the kids are buying CDs. They want something physical. I mean, there is something about the artwork that you miss if you're just online.
It's very true, actually. At Bloomberg, many years ago, there was a resurgence for records, and I went to a record pressing facility in LA for that, too. So we'll see what happens. A lot of memories, obviously, between us as well, Mr. Bell.
Yeah, so my last day's next week, this coming Thursday.
It's incredible. And it's been such an honor working with you.
John, thank you.
You know, more than 25 years ago, when I was just starting out and getting people coffee in the studio, you were the star Globe and Mail columnist and reporter, and you were always so gracious. You could have been a diva, and you were. And it's, you know, you've had such an incredible run. What you see is what you get, and you know you know, the wealth of information, the kindness, the occasional bad joke, but you know, it's. We're going to miss you, and congratulations, Andy. It's amazing.
We have a wonderful makeup lady here, Kristen Saxton.
Yes.
And she accuses me of being a stealth diva, pretending to be nice, but actually quite pushy and cantankerous.
Well, if that were really the truth, I think thered be a lot of gossip columns about it out there. It's
John,
not the case.
you.
Andy, thanks.
Thanks very much, John.
Good luck.
John Ehrlichman, you can find John's story on the BNN Bloomberg website and his Ticker Take YouTube channel. Coming up, there is optimism that the U.S. and Iran are moving towards some kind of a deal. That's next. Welcome to the second hour of our show. Let's get to the big stories we're bringing you from our newsroom. The federal government has approved a major natural gas expansion project in British Columbia. Ottawa says the $4 billion Sunrise expansion will add capacity to Enbridge's West Coast pipeline system, helping to meet growing energy demand in the province. The government says construction begins this summer, and the project will support LNG exports. Canada's February retail sales were up, but less than expected. Statistics Canada says overall retail sales increased 0.7% in February, slightly below the forecast of 0.9%. Motor vehicles and parts were the top performers. The data suggests that consumers are still spending, but cautiously, as higher prices continue to weigh on demand. Chinese exporters have started raising prices as the Iran war drives up input costs for goods. Companies say rising costs for plastic and other oil-linked products are forcing them to pass those increases along. This, of course, is after years of Chinese exports, sometimes with falling prices, help to hold prices down. Economists warn that this shift could start adding pressure to global consumer inflation. And there is a look at the TSX, slightly down in early trading. The market awaiting some kind of news on whether the US and Iran are going to start talking again. Let's have a look at the US bourses. The NASDAQ getting a lift from that surge in Intel today. The NASDAQ, where is it? 24,562. Still slightly down from its record close on Wednesday. U.S. markets up slightly today. Some investors are optimistic that the U.S. and Iran are moving closer to a resumption of peace talks. Our guest says he remains bullish on equities longer term. He thinks that the conflict in the Middle East won't be an overhang for too long. We're joined by Ian Schaefer, President and Chief Investment Officer at Gallant Advisors. Ian, thanks very much indeed for joining us. Obviously, it's probably a foolish game betting on any kind of diplomacy, but you think investors should be looking past this current disruption in the Middle East.
Well, thanks for having me on, Andrew. And basically what happens, you have these geopolitical events, and we've seen a lot of them. We've seen the Russian, invasion of Ukraine in 2022. We saw the Israel war in 2023, and now we have Iran. And the homework shows that these drawdowns that occur during these geopolitical situations, they really are measured in weeks and not months. So if you're an investor and you're looking for an opportunity for the long term to get into the market, you always want to be taking the opportunity for the sell-off to buy quality companies on sale. And that's what we've been doing. Yes, it's hard to say, is this the absolute end to the war? But you see that even, some of the deadlines have come and gone. But March was a little bit of a vacuum of news. You didn't have many earnings, companies reporting earnings. You had a lot of macro news on the headlines. And now that we're in April and it's earnings season, even though not all the negotiations are going perfectly, the market is looking to shrug it off. They're saying to themselves, I don't know if it's going to end today, tomorrow, but by June, I think we'll have some clarity and hopefully there'll be cooler heads will prevail. So people are buying. We're looking to add names that are on sale, and I think it's a healthy thing to do. Always buy low, sell high.
We're going to get into some ideas here, but it's interesting that Jensen Huang apparently says that the next generation of American millionaires will be from skilled trades like plumbing and electrical work. That's fascinating because, of course, we don't have enough of these skilled workers.
Well, for sure. And we're talking about the AI boom here when the CEO of NVIDIA is coming out and saying that. So there's a lot of, thoughts that AI, it's all about technology. And a lot of it is. But the nuts and bolts that go into AI, really provide some really compelling opportunities to invest in what used to be boring industrial dividend-paying stocks that have upside, tremendous upside, in fact, due to the AI boom. And if I'm happy to go into the stocks that we like right now, but we actually think it's very early to pick who will be the absolute winner. NVIDIA, former winner. I'm not saying it won't, go higher from here, but you can see that the market is trying to sniff out who will be next. So Marvell, AMD, they're starting to make these big moves. So what we think is, since you won't know the absolute winner or loser, why don't you take a few positions in each different part of the AI ecosystem, starting with a company that's going to be reporting next week, EMCOR. So a company in this space.
Give us a sec. Sorry, EMCOR. EME is the symbol, and just tell us.
EME is the symbol.
Engineering company. Tell us what attracts you here, please.
Yeah. Okay. So you have engineering construction. I mean, this company and Comfort Power Systems, ticker FYX, who just reported yesterday, have been on a tremendous tear over the past few years. These guys build the data centers, but they also have the janitorial services, the cleaning services. They really do all the bits and pieces that, are required to manage a data center, along with the engineering construction. So really going back to that comment by Jensen Huang, we're talking about the plumbers and the carpenters who will really be the next millionaires. This company is growing tremendously. We think it, like I said, it's number 2 to FIX, but FIX, the valuation is too high for us. So we'd rather take the number 2, a company that's done very well this year, but it's still its multiple, its earnings multiple is about 25 times. For a company that's AI segments are growing well north of 30 times, so and soon to grow higher. So we really like this story. It used to be boring, but it's not boring anymore, and it's near new high. So I'd wait for a pullback.
And then the other company you mentioned was Comfort Systems, whose symbol is FIX, and they're heating, ventilation, and I think janitorial services and stuff like that.
Yes, very similar to EME, but as I'm saying, we do not own FIX. We own EME. FIX has been a rocket ship straight up. It really hasn't given investors an opportunity to get in. So, like we said, buy low, sell high. MCOR 2 quarters ago had an opportunity where the report was solid, but some buy-side investors had higher estimates that they wanted from the report. So the stock went down. We used that as an opportunity to get in. And we were able to buy, low 600s, and now the stock is, around the 800 level, so or higher, sorry. And so, it's always be patient, have a watch list ready, and then look to see when you can get the names you want, but on sale. Very important. And the last one, Andrew, I'll mention, is a very boring utility company. Okay, so you have AEP, American Electric Power.
Okay.
So these guys are a very unique story. They're one of the largest utilities in the U.S., and they're building the AI grid of the future. And they're partnering with companies like Bloom Energy, which has also been a rocket ship and has gone straight up. And I wouldn't say to chase that company, but here's a different way you can play it. You can play it through the boring AEP, whose contracts for power are, they're contracting their backlog already to 2030 at this point, and they're building capacity, and their partnerships with companies like Bloom Energy. You really get a great opportunity to own a boring company, paying a 3% dividend, and then you have the AI upside to the story. So it could really do well, and there's an opportunity right here.
Thanks a million, Ian. Ian Schaefer, President and Chief Investment Officer at Galliant Advisors. Up next, a snapshot for the Canadian and U.S. economies. U.S. or Canadian consumers so far keeping their spending fairly solid. We'll be back. Canadian consumer spending up in February, slightly below expectations. Excuse me. Let's get more from David Doyle, Head of Economics at Macquarie Group. David, always great to hear from you. Start off, if you would, with what the numbers are telling you about Canadian consumer behavior.
Look, I think the consumer is holding up in Canada. I know we tend to focus a lot on, or there tends to be a lot of focus from the mainstream media on some of the negative points that you see out there, and those tend to get a lot of attention. But I think beneath the surface, the consumer has been steady. Retail sales growth, 3.8% year over year, 2.3% on a volume basis. And that's despite a lot of the headwinds we've seen for the housing market coming through. So I think the consumer is holding up, and maybe not be a significant source of strength, but certainly a solid contributor to economic growth for Canada.
That's interesting. Thanks for that. So I think you said we've got the number in dollar terms, but then there's a volume number, and the volume number, I guess, is adjusted for inflation, or because obviously inflation pushes up the dollar figure.
That's correct. So there's nominal retail sales growth, and that's the 3.8% number that I mentioned, and then the volume number 2.3%. Those are both year over year. The volume number would correlate with real good spending in gross domestic products. So that's the one that, as economists, we tend to put more emphasis on or pay more attention to. And that's pretty solid, especially when you consider that we now have, zero or maybe even slightly negative population growth. So on a per capita basis, at least retail sales spending looks to be doing quite well.
I'm just thinking, if we've cut back, excuse me, on newcomers to Canada, they tend to be young, they tend to be forming families, I guess. So that's going to be something of an economic drag, isn't it? If the population is aging, people aren't spending as heavily often when they get older.
Well, I mean, I think that it's a complex situation with a lot of moving parts. I do think that the per capita numbers being very strong, I think are a good thing for Canada, because for some time when we had very strong population growth, our per capita spending numbers, even our per capita GDP numbers, as we've talked about before, were quite subdued. So we've seen those pick up, and that's a good thing. I think the demography that you mentioned, for sure, spending, especially on goods, I think in particular, tends to moderate. But there tends to be a pickup in services amongst older individuals. Healthcare spending, for example, becomes more significant now in Canada. That might be more coming from government spending than individuals, in contrast to the U.S. in terms of how the data are collected and gathered. But also travel, for example, can pick up. A lot of retirees, baby boom generation tends to be more inclined to travel. So the spending mix will shift on the demographic changes. The overall numbers, I think, there's some moving parts.
I just want to share with you a breaking headline here. ABC is reporting that the Department of Justice is expected to drop the criminal probe of the Fed chief, Jay Powell. That's from ABC, and I know you probably don't want to get into the politics of that whole thing, but if that's true, then presumably it will ease the nomination of Kevin Warsh as the new Fed boss.
Yeah, so I think that news is welcome news from a Fed independence perspective. I think that had been, there'd been some concerns there. I think that, yes, Tom Tillis, one of the members of the Senate Banking Committee, had suggested he would hold up the nomination unless that investigation was dropped. So very likely you'll see that proceed and likely approved through the Senate Banking Committee and then subsequently through the broader Senate in a vote. We'll see. Chair Powell's term is set to expire on the 15th of May. So I'm not familiar with the exact timelines, but this does set the stage for Warsh to soon come in as chair of the Fed.
Let's have a look at, say, a 5-year chart for the U.S. 10-year bond yield. Is the market fairly comfortable in the United States that inflation is under control? I know gas prices have surged, but are there fears there's fundamental inflation in the system?
So I don't think that there's concerns about inflation being on a runaway, right? So when you say runaway, accelerating inflation, a lot of people suggest that, point out like it's similar to the 1970s. They talk about stagflation when we went up to, double-digit levels of inflation. I don't think that there's fears of that out there. From the conversations I've had with folks, there is concern that potentially, we're in a regime of a bit higher inflation than what we were for most of the 2000 to 2020 period. I think we've been exceeding, the Fed has been exceeding its core PCE inflation target of 2% for, the better part of 5+ years, maybe even longer than that now. And, once that occurs, you wonder, okay, well, this is proving to be a little bit stickier than some folks expected. So are we in a regime where inflation is 2.5% or 3%? And that's sort of what we should have as our underlying assumptions. So that tends to be where the debate is coming from. It's less it's more so in that front rather than are we on the cusp of some sort of spooky, accelerating inflation type situation.
I like that, spooky accelerating inflation. And AI is obviously a massive story. What do you think when you hear forecasts? There's going to be huge job losses among white-collar workers in short order.
I tend to take the other side of that. I think that for the most part, AI is going to improve individual productivity growth. And as a result, that'll actually lead to a higher standard of living across the economy. I think a lot of time those headlines of job losses tend to get exaggerated attention. But in the grand scheme of things, you don't really see them move the monthly numbers of payrolls gains or even the unemployment rate. I'd add too that AI, maybe there's some reduced demand for knowledge workers as a result of AI in certain sectors. I think there is some evidence on that side. But to your earlier comment on demographics and labor force growth, AI is arriving at exactly the time that we need it, right? So if population growth is near zero in both Canada and the United States, and these immigration policies remain in place, to drive economic growth, we can't rely on labor force growth. We have to rely on productivity growth. And AI, I think, is going to be a driver of a bit of a pickup in productivity growth. Not some of the numbers you see touted in some corners of say, 10% or 15% per year, but could AI move us from a regime of 1.5% productivity growth to 2.5% productivity growth? I think that's very possible. And I think there's some evidence that may, that could be happening in some sectors. And if it broadens out, it would be a great thing, I think, for both the U.S. and Canadian economies.
David, thank you very much indeed. Really appreciate it. David Doyle, Head of Economics at Macquarie Group. And just to remind you that we are hearing now that Department of Justice probe of U.S. Fed Chief Jay Powell has now been canceled by the Department of Justice. I don't know if we've had confirmation, but apparently U.S. Attorney General for D.C., Jeanine Pirro, has directed her office to close the investigation. And of course, that creates, probably opens the door, if true, for Kevin Warsh, President Trump's pick, to take over at the Fed. Coming up, shares in Intel on fire this morning. Shares in Intel on fire today. I'm kind of confused as to why this is only coming up now, but it seems the central processing units for computers, that's long been Intel's specialty, are also important to AI. Let's get more from Gil Luria, Head of Technology Research at D.A. Davidson. Gil, maybe you can help me with this. So are investors only finding out now that these CPUs are so important?
Things are moving fast, and it's really just over the last few weeks that we've realized how much more we need CPUs. And the math around this is that when you're doing pre-training for AI, when you're just preparing the models, you need about 1 CPU for every 8 GPUs. By the time you're doing agentic tasks for AI, it's more of a 1-to-1 ratio. So if we've just needed a lot of GPUs up until now we also need a lot of CPUs to execute the tasks that we're setting these AI agents to do. And that's just really over the last few weeks. Let's not forget the big revolution around agents really just started in December with some of the Anthropic models. But now as that's happening, the demand for CPU is going off the charts. The most interesting anecdote from Intel yesterday was that they were selling previously written down CPUs, which is to say they took them out of the trash in order to sell them, and they were still able to do that. So that tells you how much the demand has picked up over a matter of a couple of months, few weeks.
That's interesting. So training the AI takes vast amounts of these graphic processing units, but actually running the programs, you do need lots of CPUs.
Yes. Now, that doesn't mean you don't need the GPUs. No. It's just that for the actual actions, to make the compute efficient, you want to use CPUs. Think about it this way. What does an agent do? The agent is doing cognitive tasks that a human would otherwise do. And most of those tasks right now happen on a CPU. When we work on a computer, we're using the CPU. So if a computer's doing a task that otherwise we would have been doing, it's using the CPU. That doesn't mean you don't need the GPU for the actual inference, for the actual computations that tell you what task to do. It just means that to carry out the task, you now need a CPU.
You are hiking your target price on Intel to $77 from $45 US, but you're maintaining a neutral rating. Walk us through your thinking there, please.
That there's still so much risk with Intel. We're all valuing Intel based on its product business. in spite of the fact that the foundry business, the fab, is losing a tremendous amount of money. So that means that we're all implicitly saying we believe that the fab will at some point stop losing money, maybe even make money. But that's a really big if statement. But by their own account, for their next node to work, they still need to sign up new customers. Even the deal with Elon about the terafab may not be enough to decide to invest in the next generation of a node, the 14A node. And so we don't even know that business will stop losing money. And that's what we're all assuming in order to value Intel. So the point is there's a lot of risk. If the fab side doesn't turn around, they'll continue to lose a lot of money there. And then the overall company will still lose money. Just to give you context, how badly Intel is underperforming. Intel's margins were 39% this quarter. That was a big positive surprise. AMD's are 55%.
Oh.
NVIDIA, Broadcom, TSMC 75%. Intel is still a very big underperformer, and it's not clear that they can get out of that. All that's clear is the demand for CPUs is so high, the tide is rising so fast that it's even lifting Intel's boat.
So you mentioned terafab. So that is a giant semiconductor plant that is apparently scheduled for Texas. Elon Musk is involved, Tesla, XAI, SpaceX, and Intel. Give us a bit of background there. So Intel is partner with Elon Musk in this thing.
Yeah, it's unclear what their role is. What we do know is that Tesla intends to use the 14A technology, the next node technology from Intel for the terafab, but it's going to be an Elon plant. It's not going to be an Intel plant. That's what it looks like. The details still haven't been worked out. This may not even happen till 2028, or at least not open till 2028. So we don't know a lot of details. We just know that this is Elon's scale, right? So it'll be the biggest plant ever, and he'll probably build it faster than anybody's ever built a plant, or at least that's his intention. And it is a big deal that they picked Intel's technology to do that.
Yeah.
But again, it may not be enough, because Lip-Bu Tan clarified again yesterday, they are still not committed to building out the fabs for 14A. They still need more customers. They're in the process of having customers test out the technology, and they may be able to sign large customers. Again, the hope is an NVIDIA or an Apple or something like that that's big enough to commit to the technology, to commit to building fabs. The terafab itself will use the technology. It's not clear that it'll be an Intel plant. It may be an Elon plant.
Gil, thank you very much indeed. Great hearing from you. Gil Luria, Head of Tech Research at D.A. Davidson. Coming up, we're going to bring you the latest headlines and markets and a few notable calls from analysts, including a price target boost for Celestica, which has been hitting record highs. The federal government has approved a major natural gas expansion project in BC. Ottawa says the $4 billion Sunrise program will add capacity to Enbridge's West Coast pipeline system, helping to meet growing energy demand in the province. And the government says it will support LNG exports. Canadian AI company Cohere has signed a deal with Germany's Aleph Alpha in a bid to create an independent alternative artificial intelligence company. Of course, this is a sector right now dominated by the US and China. The companies say it will function as a transatlantic AI powerhouse, anchored in both Canada and Germany. They also said that a German company, Schwarz Group, will invest €500 million euros as the lead investor in an upcoming financing round. And shares in Procter & Gamble are higher. The company beat sales expectations in its third quarter, driven by growth in the beauty category. The consumer goods giant saw the highest organic growth in more than a year, signaling steady demand for everyday products. And P&G is sticking with its outlook for the current fiscal year ending in June, but it is warning of higher commodity costs. TSX slipping slightly in early trading. You can see the Nasdaq and the S&P 500 moving higher. I'm just looking at the big traders now in Toronto. Topping the list, Royal Bank of Canada is down slightly. Bank of Montreal higher. Celestica jumping about $17. Shopify down. So I don't think there's a clear program. Constellation Software also down. Remember, results from ServiceNow this week increased fears about the impact of AI on traditional software companies. Let's get to some notable analyst calls this morning. Canaccord is raising its price target on tech resources to $85.50 from $78 Canadian, and sticking with the hold rating. The firm is updating its model after Q1 results, which Canaccord says were positive but neutral to the broader investment thesis, given that the merger or the takeover by Anglo American is in its final stages. National Bank upgrading Sun Life Financial to outperform from sector perform with a price target of $109. The firm cites increased confidence in the turnaround at Sun Life's U.S. segment. And let's have another look at Celestica, which has been hitting record highs. BMO is raising its price target on Celestica to $450 from $370. And Celestica, of course, on fire right now because of hopes that its massive hardware business will be boosted by ongoing investment in AI equipment. So there is Celestica. Look at that. That stock up well over fourfold in the past year. Just on AI, I mentioned that team up between Canada's Cohere and Aleph Alpha. This is it's getting backing of about $500 million from a German retailer, Schwarz Group, which is the parent of Lidl. So it's owned by Dieter Schwarz, and he is a grocery billionaire behind Lidl, the big discounter. It would be great to see Lidl come into this country, increasing a bit competition in a grocery. And I think we've one more. Yeah, we've one more analyst called Bank of America analyst Michael Fenninger, raising his price target on Caterpillar to $930 US from $825, sticking with the buy rating. The company, of course, is vulnerable to tariff expenses, but it has that power and demand segment, generation equipment, and once again, that is seen as a play on the AI build-out. The analyst thinks a higher multiple for the stock is warranted. Coming up next, Hot Picks. We dive into 3 specialty retail ideas. It's time for Hot Picks. So we're looking at 3 ideas in specialty retail. The first company makes a sock that doubles as a baby monitor of sorts. Let's get more from Jonna Kim, VP and Consumer Research Analyst at TD Cowen. Thanks very much indeed for joining us.
Thanks, Andrew. Nice to be here.
Tell us about the company behind this baby sock and how does it work as a sort of monitor?
Yeah, it's a unique company. It's a disruptor in the baby monitoring category. There's a Dream Sock which monitors the baby's heart and other biometrics, and they're the only FDA cleared baby monitoring device in the industry. So there's substantial white space in the U.S. from both the hardware as well as subscription perspective. So they first rolled out the baby sock, and then they added on the updated camera on top of that, and then there is now subscription that enables the moms and dads to track the health of the baby, and then it is up to 18 months where the baby can use this feature. So it is in a very disrupted category, and they're the leader. Valuation, it has also come in the last earnings. It trades below 1 times FY2 EBITDA sales at this point. So we still think there's a long-term story here. A lot of white space, as I mentioned, within the U.S. And also internationally is a growth story for them.
Sorry, did you say white space, Jonna?
Yes, exactly. Yep.
What do you mean in that context there by white space?
Yeah, the adoption. So in a market that is very mature, I believe Utah is the mature market, about 20% adoption rate there, while the whole entire US, there's about 10% adoption. So, there is that incremental sort of adoption that you can get with parents. And this is very community driven, sort of word of mouth type of product. Therefore, if the new moms and dads come in and use this product and love it, and recommend to other parents, there's a flywheel effect that comes with it. So there is a lot of that opportunity, for the company. And as I mentioned, they're also venturing out to other international markets, but the key focus will be in the U.S.
That's fascinating. So the Dream Sock, helping parents to keep an eye on the baby. Shark Ninja. I think they're involved in blenders, coffee makers, juicers. What draws you to that stock?
Yeah, so as you mentioned, they're the small appliances in kitchen and in the broader home. They operate both 2 brands, Shark and Ninja. I would say they're a very unique story in consumer where you don't get a lot of the sort of low to mid-teens grower. They are able to do that with their innovation pipeline. They go into 2 categories a year with 25 new products. And really the secret sauce there is marrying that innovation with social media and community-driven sort of word of mouth here again, where really the users post their experience, and then it catches a lot of other users to look at the products online. So that has been sort of the underpinning growth driver for them. Here also, the US is the majority, but there's a lot of growth happening internationally, about 30% currently, and the plan is to go about 50% of the mix. So a lot of substantial opportunities to grow share within the US and abroad as well.
The shares have come off their peak. Why is that?
Yeah, it's mostly on the macro trade, I would say, and obviously they are exposed to freight and higher, sort of plastic and resin cost. But they do use a lot of third party. They don't have, manufacturing on their own. So there is not a direct impact, I would say, in the near term. And consumer, obviously, demand is something that we are watching across the board. But they do skew more towards higher income, and there's that virality of these products and they have pricing power even in a tough market. So we still feel pretty constructive about their longevity here.
Your final idea is Gap. One of the attractions here, you think, is signs of health or recovery at their Athleta business. But broadly, what draws you to Gap?
Yeah, I would say in specialty, it's tough to deliver consistent sort of growth and execution. But, the Gap brand, they have 4 brands, as you know, Gap, Old Navy, Banana Republic, and Athleta. The Gap and Old Navy execution really has been strong. And I think it's gaining a lot of mind share and wallet share and becoming more culturally relevant. They do have Banana Republic and Athleta that could be improving. So that is sort of the next term of catalyst. But immediately in the near term, the consistent execution at Gap and Old Navy is what gets me excited. Also, they're rolling out beauty and accessories across those 2 major brands, which should be a boost to traffic. It's going to be a gradual rollout, but we feel good about that adding consistent comp growth for the concept.
That's interesting. So they are going to be selling cosmetic skincare stuff?
It's less of, I would say, skincare. There's fragrance component, more, Gap used to have fragrance, so they're bringing that back. Old Navy will have shop and shop in stores where they do have different different brands as well as their their brand as well. So it's bringing sort of that traffic into the store and cross-selling across different products they have.
That's interesting. It's, as you say, they're very diversified and, wow, they've been around for a long time, Gap, but you're seeing signs of health there. Thank you very much, Jonna Kim, joining us there. Really appreciate it. Vice President and Consumer Research Analyst at TD Cowen. That dream sock, that's interesting. You know, sleep experts apparently say you should wear socks in bed. It convinces your body that you're warm enough and you sleep better. Coming up, we're going to update you on the markets and we'll tell you about a cautionary tale from the booming online betting market, highlighting risks here. Back in a moment. The popular Bay of Fundy lighthouse won't open this season due to budget cuts. CTV's Laura Brown reports on why Cape and Rage usually draws thousands of visitors and what they're going to be missing this year.
It gets its name from the way the water violently battles the reef below it. This is Cape and Rage. The current lighthouse is over 100 years old. The site offers tours, a restaurant, and zip line. You can even rappel down one of the magnificent cliffs. At least, you could.
It's kind of like getting fired, you know, it was short and sweet.
Jim Campbell, who's worked at Cape and Rage for years and is currently on the board of directors, said he was informed by the province just last week that the not-for-profit, which runs the site's operations, would not be receiving the bulk of the funding it needs this season. They could have $30,000 of the $130,000 they normally see. Campbell says that's just not enough.
I'm saddened that something like this can't be funded.
New Brunswick's tourism department said in a statement to CTV News the situation is unfortunate and they are hoping to find some sort of a solution. The province has made cuts to museums and tourist attractions in this year's budget due to a historic $1.4 billion deficit.
I feel it's terribly sad. It's a waste of a beautiful, beautiful location for many tourists across Canada and the U.S.
Oh, Cape and Rage. My heart and soul was at Cape and Rage.
Michelle Harvey Larson owns a gallery nearby. In just a few weeks, the area comes alive, she says, with visitors. The site usually sees 20 to 25,000 tourists each year.
Cape and Rage was on the advertisement of the province. When you landed at the airport, this is who welcomed you, and this was Cape and Rage.
They're confused by the decision, if a little enraged. Laura Brown, CTV News, Cape and Rage, New Brunswick.
Let's check in on the markets. Maybe we'll have a look at a 1 week for the TSX. Of course, energy stocks on something of a roller coaster with fears that this ongoing Strait of Hormuz shutdown will drag on. And of course, in some ways, the energy crisis still only biting as actual physical supplies run out in many crucial regions, including Asia and Europe. There's the TSX Composite actually losing about 1.5% over the past week. A couple of stocks, though, that are doing well. Let's have a look at Aritzia, because that stock hitting a record high today. There are great hopes for its U.S. franchise, and that stock's been a winner, up more than fourfold in the past 5 years. Told you earlier about an upgrade for Sun Life. And that stock hitting a record high today as well. It got an upgrade at National Bank citing a turnaround in its U.S. operations. And so that stock hitting, as I say, a new high. Enbridge getting a federal government approval for a massive natural gas pipeline expansion in BC. And that stock gaining a little bit as well. Let's have a look at American stocks over the past week, because they've been trading largely on headlines about the Persian Gulf. There are hopes now that the Americans and Iranians are anxious to get some kind of a deal in place. We have had saber rattling from the White House. However, there's a report now that Iran's chief diplomat is going to visit Pakistan. Also, just a reminder, we've got to confirm now that the Department of Justice is dropping the investigation of the Fed chief, Jay Powell. He was supposedly being investigated because of cost overrun on renovation to the Fed's headquarters. But this criminal investigation being dropped, according to U.S. Attorney Janine Pirro. And there is the NASDAQ this week gaining slightly. Let's have a quick look. Let's have a look at copper, because copper, we do know, is at risk of running short with all this massive electrical installation around the world. And copper up 20% plus in the past year. I'm just looking at the U.S. The generic futures for copper did hit $6.20 a pound in January, at the end of January. So they're still slightly down from that level. And finally, let's have a look at the Canadian dollar, if we have time to do that. And it's holding its own today, 73 cents US, slightly more. The explosive growth of online betting is now colliding with U.S. national security concerns. A U.S. Special Forces soldier is facing charges after allegedly profiting more than $400,000 by betting on the removal of Venezuelan President Nicolas Maduro. Prosecutors say he used insider knowledge of a commando operation, a failed operation. ABC has the story.
This morning, a Special Forces soldier is due in federal court on charges he used classified information to bet on the commando raid that ousted Venezuelan strongman Nicolas Maduro before it happened. Federal prosecutors said Master Sergeant Gannon Ken Van Dyke placed bets on Polymarket on the timing and outcome of that very operation, all to turn a profit of more than $400,000. While helping to plan and execute the operation to capture Maduro, the indictment said Van Dyke opened a Polymarket account and traded on Maduro and Venezuela-related contracts on 13 separate occasions, including in the hours before the raid when he wagered Maduro out by January 31st. The soldier is charged with fraud and unlawful use of confidential government information for personal gain, the first time the Justice Department is prosecuting alleged insider trading on a prediction market. There are now calls for Congress to investigate well-timed bets on prediction markets. A Polymarket user made more than $500,000 through a series of bets related to the war in Iran and the toppling of Ayatollah Ali Khamenei. And right before President Trump scrapped plans to attack Iranian power plants, traders successfully bet almost $1 billion oil prices would fall. Asked whether he's concerned federal employees like the soldier now facing criminal charges may be profiting from inside information, the president appeared to downplay it.
That's like Pete Rose betting on his own team. It's a little like Pete Rose. Pete Rose, they kept him out of the Hall of Fame because he bet on his own team. Now, if he bet against his team, that would be no good, but he bet on his own team. I'll look into it.
Okay, I got mixed up there. It wasn't a failed commando operation. They did get Maduro. That's interesting, though. President Trump not worried about this particular example of betting, alleged example of betting on inside knowledge. It's a golden age for gambling if you're interested in that. Let's maybe have one last look at the TSX over the past 1 year, 12 months. Because our market has been outpacing the U.S., but only narrowly now. 6.7% is the gain for the TSX this calendar year. 6.7%. Actually, the NASDAQ is now up around 6.2%, so nearly as much. The S&P still a bit behind. It's up 4.2%. European stocks, as you might expect, are up less. The Euro stocks 50 is up only about 1.6% because, of course, Europe does face extra pain from this energy crunch around the world. Europe gets so much of its energy from the Persian Gulf. And Japan, still on fire. Japan, despite the cost of higher oil, is up around, the Nikkei is up about 19% this year. Thanks for watching The Open. Morning markets are up next.